Good afternoon, everybody. Thank you very much for joining this Asset Finance Connect webinar. How broker technology is creating new opportunities for brokers in vendor finance. We're delighted to have an audience that includes many brokers and many bank-owned lenders and privately owned lenders. So thank you very much for joining us this afternoon. We have an incredibly interesting panel who we'll introduce in just one second. Just to repeat the topic today, we've noticed that banks and independent lenders have traditionally dominated vendor finance, and with brokers only getting a look in when hard to lend to end customers don't fit the primary lender's risk appetite. There is an emergence of a new breed of tech-savvy brokers, which is creating increased interest from brokers keen to win an increased share of vendor business, attempting to displace the lender as the primary in the relationship and offering vendors a more comprehensive finance service for their end customers, whatever their creditworthiness. So in this webinar for the next hour, we've got an excellent panel of experts, some representing lenders, some representing hybrids, and we've got Jason from NETSOL, who will bring the tech input to this discussion. This is an Asset Finance Connect webinar, but we should stress that it's sponsored by NETSOL. And Jason, if I could just ask you to give a 1-minute thumbnail as to what NETSOL do.
Sure, I promise not to do too much of a sales pitch. So NETSOL have been in the leasing technology space for some 40 years now, in Europe and around the world. Traditionally, we've been in the contract management space, so the loan management systems, but in the last few years, we're very, very active in the origination space, both for lenders and now brokers and dealers, because we've got very, very flexible technology that's accessible by a much broader audience. So we're seeing an awful lot of activity in this space around the hypothesis of this webinar. So it's quite an interesting area.
Thank you, Jason. Thank you very much. And thank you very much for sponsoring this webinar. So now to introduce our panel, we've got a fantastic panel today. Vincenzo Scalzoni, the Head of Technology, Healthcare and Green Energy at Société Générale Equipment Finance. Great to have you with us, Vincenzo.
Thank you. Great to be here.
We have Malcolm Workman, who is the Chief Operating Officer of Shire Leasing. Malcolm, great to have you join us.
It's good to be here.
Thank you. And we have Joe Lloyd, who is the Director of Complete Leasing. Joe, thank you very much for joining our webinar.
Great to be here. Thank you.
Great stuff. Okay, so as ever with our webinars, we usually divide the topic up into 3 subsections of 20 minutes. And we'll introduce each section by posing a question to the audience. So as we sort of get into this, Edward will pose the question. You will have a chance online to vote for one of the 5 answers that you have. And at the end of the 20-minute session, we will have a look and see what the audience's answers were to the questions. So Edward, introduce the first question, and then we'll get into the topic with the panel.
Okay, great. Just to add, if you the great thing about webcasts are that you can ask questions and I can get answers for you at any time. So if you want to ask a question, just tap it into the poll area and I will interrupt John at some point and make sure that your question gets answered. And if there are too many questions, we'll put them together into a little report and send them to you afterwards. But that's a really big part of it. So the more you ask, the better the event will be. Okay, let's start with the first poll, which I've just pressed launch on. Hopefully it will do. So the first question is, digital makes it easy for a vendor and end customer to treat finance as just another payment options. This is the role of technology. If the CX, customer experience, is good and the terms are right, it doesn't really matter who funds the deal. So you don't need vendor finance, big banks. You can have a broker or anybody else, providing they provide the service. So if you could answer that now, I'd be grateful. Back to you, John.
Thank you very much indeed, Edward. Thank you very much. Okay, so this first section we've sort of roughly broken down as technology is eroding the traditional boundaries between brokers and lenders, opening up new business opportunities for the brokers. As we said before, we have this perfect panel of a mixture of lenders, a hybrid lender, intermediary, and an intermediary. Vincenzo, if I can come to you first of all, you work for Societe Generale Equipment Finance, which has long been known as a lender. It's a global finance company that has generated large volumes of its business through vendor finance. Can you just explain to the audience briefly sort of how Societe Generale comes to be where it is and why it sees the importance of having these vendor programs to generate its business?
Yeah, thank you, John, and welcome everybody. And I'm very excited to be part of this very distinguished panel of speakers. I work for Societe Generale Equipment Finance, is a global finance company. We've been in the UK for 25 years. When you, John, were the managing director of the company, I think, the company is global, and our go-to-market strategy is through vendors. So it's an indirect approach. We have developed in the last 25 years very strong relationship with manufacturers, their distributors, and their resellers, whether it is on the technology sector, which has been really the starting point of SG Equipment Finance 25 years ago, or in transportation, industrial, construction, agriculture. But I have to say as well that we are working very effectively with the broker community, especially in the UK. A large part of our business is originated by brokers, whether they are in agriculture, transportation, industrial, construction, or medical equipment and IT. I think the SG Equipment Finance is offering an excellent service to vendor and manufacturer, but as usual, there is always a part of the service that can be improved further. What I see is, that's the way of working with vendor has changed during the years, and the parts, the technology, let's say the part played by the technology has been more and more taking more and more space and being more and more relevant. Now, without jumping to the conclusion of the webcast, I want to acknowledge the fact that we do see, some brokers, especially in the UK, being very à la page when it comes to that technology agility and making sure that the customer journey is very slick and memorable for the customer. I think that lenders are catching up with that. Lenders, especially if you are subsidiary of a bank like we are, there are a certain number of challenges in upgrading the legacy system, which, in order to make that legacy system a little bit more, API ready, for instance. Now, the good thing, John, and without making this all about that, we are, SG Equipment Finance is investing a lot in a new front-end tool, middle office and back office, which we're going to launch in the next couple of months, and that will allow us to catch up in that technology journey and propose a better customer experience.
Excuse me for interrupting, and this wasn't what we scripted in the prep calls, but what you just said forces me almost to ask this, and I'd really be interested in Joe and Malcolm and Jason's view on this. It sounds to me from what you're saying there is that changing a legacy system that you've had for a long time to make it agile and at point in this market you're suggesting is more difficult than building a brand new system that perhaps some of the intermediaries are able to do because they don't have a legacy system. Is that partly what you're saying?
To some extent, yes. And some of the brokers, for instance, they can keep that agility because they don't have a book, or they have a very small book made of a certain number of, I don't know, a couple of thousands of contracts rather than 50 or 60,000 contracts, active contracts for a lender. So I think that the brokers can be very agile because they can, instead of embarking on that journey to change something that is already there, they can reinvent the wheel, if you want.
Vincenzo, I'll come back to you, but can I just ask Malcolm and Joe whether they think as well? I know, Joe, you've just recently created or launched or written a new system yourself. Do you think you were in a better position from being able to start from scratch rather than have a legacy system you had to change?
Yeah, well, absolutely. I mean, we have a system at the moment. We haven't implemented the new one yet, but yes, we have a system which we've had in existence for about 15 years. And it's fine, it works. But as regulation increased with KYC and other stuff that we need to build into our processes, it became clunky. So we're as a broker, we're all about service because we haven't always got price. Okay.
Right.
What is attractive to vendors about that is the fact that we have a diverse lending panel. So choice in many ways outweighs price, but we'll come back to price in a bit. But we're constantly looking at our vendor journey and how can we have less touches on a deal to get it from proposal to payout without compromising with KYC and all the regulatory things that we've got to do. So we spent quite a long time in the market looking at different systems, and the subscription pay-per-user model just meant for us that we came to the conclusion that it was going to be too expensive for us to do that as we grow. And then once you've bought into a system, you're hamstrung because you've got to use it. Once you're in, you're in. So we thought, right, okay, rather than potentially spending however many £1,000 a month to a software company that could get bought, could change their pricing, could do a number of things, we decided to invest the money in starting afresh. So we're on that journey at the moment. We're at testing stage. It's reliant largely with funders having API links with funders, and those APIs working with the funders that we do most of our business with. Because our lending panel is diverse, we're never going to have APIs with everybody because we deal with a range of varying size banks and finance companies. But our focus is to try and get from proposal to payout electronically and in theory within an hour or two. So if you've got a supplier that can use your portal, which we will have, they can propose the deal into us. We can then bounce that on to a funder that will have auto underwrite. That auto decision tool will bounce back to us, and then that will automatically bounce on then to the portal, the supplier portal. So there's a journey from proposal to accept. Then the next stage is obviously to get the customer engaged and get the paperwork signed and transact the deal. So all of that data is pulled through to an e-document in an ideal world, and that is then bounced onto the customer.
Right, excellent. Joe, thank you. And I think that does suggest, as Vincenzo said, that perhaps it is easier to start from scratch with building a new system than it is to adapt.
Absolutely. Out of all the people here, we're by far the smallest business. So clearly we can be more agile. That's.
Yeah, and I apologize, Malcolm. Sorry, Malcolm, if I can come to you and just perhaps a bit quicker because we're already nearly at the end of our first 20 minutes. Malcolm, just your view on whether it's easier to start again from scratch with a new system or adapt a legacy system?
It's definitely easier to start from scratch. I mean, the Shire is a broker for over 30 years now, and it's developed into a hybrid funder at 70% on its own book and 30% broked. And this is all about service and speed. We're here to support the SMEs, and the way we've done that is making things really low touch. So right from web portals to e-sign documents, and having universal documents that we can put either on our own book or we can place into the market, so it doesn't affect the customer or the supplier. We have typically auto decision and accept rates of about 50% in the supplier-led market. So these things are really important. And if I look at last month as an example, the average turnaround was 1 hour, 4 minutes for all the business that came in. And there was only 4% over 4 hours. And this is key because we can't compete with the big banks. And the thing that we really like is that the big banks don't want to compete with us either. Our specialist slot is that sort of £1,000 up to 25,000, no touch churn type of deal. There's a lot of banks and funders out there aren't really that interested if it's below 25,000, and they'll get their benefit through things like block discounting and funding us to help the market. So they get a bit of a win-win in that sense. And we continue to develop our offering, and whenever we get a new proposition, we can move very fleet of foot. We have a transformation director and a very strong IT team with in-house developers that sort of move quickly on that. So couldn't agree more that we've got the ability to move fast.
Thank you, Malcolm. That's brilliant. Jason, if I can come to you now then as a supplier of the technology that some of these people are talking about, presumably they're your customers, so hopefully you have some sympathy with their position that it's easier to start from scratch than it is to change a legacy system.
Yeah, I mean, for sure. I mean, it's interesting going back to Vincenzo's comments that, almost underneath some of that, if I may, is some concerns that brokers are going to provide a better service from a tech perspective than you can because of the legacy challenges of upgrading. Whereas I think the hypothesis for this call perhaps was brokers catching you up because, to commend you, you've been deploying tech into the dealer channel for 10, 15 years. It's not new to you, it's new to the rest of the market. And because that's always been a fundamental requirement to win business in the dealer channel, is to make it super easy and have tech in there to get the deal through so the dealer can carry on selling what it is they're selling. So it's interesting you're seeing a brokers potentially overtaking rather than catching up. But without question, always, to upgrade. I've spent my entire career in banking and lending and driving growth, transformation, and tech, and upgrading from old to new is never easy. There are lots of providers out there that can make it easier, but it's never easy. So there's always a slow journey getting governance and approval and all that good stuff. And what we're seeing, and brokers don't have that problem because they're investing in tech for the first time in large part. So it's almost like a greenfield opportunity. And we're seeing a lot of interest in that at the moment, where brokers are able to sort of take it and deploy it very, very quickly with all the kind of modern components and ease of journey that the dealers expect. And they're able to do that at a price point that's way more accessible than it used to, because cloud-based technology is very, very configurable and accessible these days. So it's the opportunity as tech has moved on has opened up to the broker market and made it accessible without the need for giant tech projects and budgets that scare people.
Fantastic. Thank you, Jason. And again, as I say, I was really interested in the question about this technology change, because that's the hub of what we're talking about. Vincenzo, thank you very much for introducing the SCEF model to us. That's probably what we were supposed to be talking about in this first section. And again, it was me that diverted the conversation. Malcolm, if I can, and I can ask you to be fairly quick, just briefly introduce the Shire business model, because Vincenzo's told us that SCEF can be direct to the vendors, but it also gets lots of business from brokers as well. So it's got to service both channels. If you can tell us your business model and how you source that business.
Yeah, the business model is sourced predominantly through suppliers, and that's right from regional suppliers up to manufacturer level and national. And then what we do is we serve those, and then we cross-sell to that population to sell assets and facilities that are outside of that other supplier. And then we also make sure we work with the existing supplier to upgrade their base as and when agreements come to an end. So we've got very long-term relationships within there. In fact, we continue to win supplier relationships due to the technology we have and the the fleet of touch, and we've gone over 200 million on our own book. We've grown that from very low levels about 10 years ago to over 200 million now, and 70% of everything that goes onto our own book. And we just find we're in control of it then. And if we decide and we take the pain away from the customer and the supplier, and it means it's less price sensitive in the model you're looking at there. So that's the model we work with. We're a very large independent, and we punch quite well in our market. So it's a tough place to be, and customers have got lots of choice, and we want to choose us. So.
Can I just pick up on one thing before, and the same question to Joe after we've asked him to introduce the complete leasing business model. You mentioned that you often originate the first transactions through a dealer or a reseller or a manufacturer relationship, and then I think when we were prepping, you said, and then something like 40% of your business comes from remarketing to that end user that came via that dealer. Those dealers don't have any issue with you remarketing a customer that they originally bought to you?
The only issue they would have is if you were remarketing in the same sector. I mean, we're looking at very different. If we look at the supplier area, the average deal size is sort of 7 to 10k. When we're cross-selling to them, it's for very different projects, from their directors' cars to their to wider projects, and the deal sizes are normally 50k plus in those scenarios. So it's a very different area. What we're not doing is we're not having any part of. We're there to support them in that sector. So it's always very different lending, and we also have other sister businesses that will support them in other angles, such as invoice finance, as an example, or loans, etc. So there's lots of things we can do with that. But we're there to serve the customers, and we really don't get any complaints from our supplier base, because we're very supportive of them, and we just look to make. We want to make them be able to sell more into their market. So, and because we support the SMEs, and right from the small deals up to the large deals, from the easy credits that all the banks can take down to the tougher credits that we can build schemes around, then it serves them well.
Malcolm, thank you very much indeed. Joe, if I can come back to you, you gave us a little bit of your business model. I think from the prep call, you keep a smaller percentage of the business, but you have a similar strategy of generating the first deal through a supplier or a manufacturer, and then selling on to that customer.
Absolutely, yeah. In very same way that Malcolm described it. All of our business, the vast majority of it, comes in the first stage from vendors. These are supplier relationships that we've had for a long time, and like Shire and all of the other brokers out there, they're continually looking to build new supplier relationships, or take relationships away from competitors. So we like that model because we understand the provenance of the deal. The supplier has invariably had quite a few touches with the customer or visited the customer before we get the introduction. It helps eliminate fraud. We do get web inquiries, but we proceed with caution, because the odd time that fraud has crossed our door, it's generally been a sort of customer-led web inquiry. So that model works for us. We like it. We do cross-sell. As Malcolm said, directors' cars or other types of equipment that's doesn't compromise the original introduction.
Thank you, Joe. And Vincenzo, just to come full circle back to you.
Yeah.
Do you cross-sell and leverage the book that Skef has?
Right. I wanted to come back to a couple of things that Malcolm said, but even Joe mentioned that, which I think is a fundamental difference there, and it is a trend we're seeing in the market more and more. It's the size, the value of the average deal size. Big lenders don't tend to touch that business anymore. And they rely on aggregators like brokers, like Shire, like Complete Finance, to finance that through block discounting or buying portfolios. So that's very interesting, because it's one of the it's why some relationships with manufacturers are not picked up by the lender, basically because the opportunity is not there. There are lenders, for instance, that if you cannot generate opportunities for 2 million or 5 million or 10 million in a particular year, they're not going to have the resources to dedicate to that particular program. So this is definitely a separation between the broker world and the lender world. We at SG Equipment Finance, for instance, we've been in situations where we have introduced some of the manufacturers, especially in the technology side, to a broker because they were not big enough for us, and the broker picked up that relationship, and as Malcolm said, it's a win-win because we're going to get some of that business anyway. On the upsell part, again, in our situation, sometimes those programs are quite complex. When you work with an IT manufacturer or a transportation manufacturer, the lender is going to most probably address the top of the pyramid of customers, the named customers, the named accounts. That is, I don't know, 30-40% of the total sales of that particular vendor. Sometimes those programs are a little bit more sophisticated in the sense that instead of using a Société Générale Equipment Finance or a lender documentation, you are hiding behind a white label. So it's the manufacturer that is using his own logo on a finance agreement with the customer. It would be very awkward then for SG Equipment Finance to call the customer and say, oh, by the way, we did this deal with you, but actually we were behind the manufacturer. Yeah. Do you need a car or do you need anything else? Yeah. It's just not going to work. So in the majority of what we do, we respect that relationship, commercial relationship between the manufacturer, vendor, and the customer. And by the way, I want to reassure all the brokers that work with us and they're watching. Hey, we don't call you customer, don't worry. So we respect that relationship as well. We obviously the commercial relationship stays with the originator, which in this case, is the broker. Now we do a little bit of upselling, John, and in specific situations where the transaction is come from, for instance, our bank, our parent company, or if the customer has been introduced by vendors that don't really attach much importance to that customer relationship. For instance, John, today I am in a customer premises that I visited with my sales team. They came from a vendor. The vendor is not attached to that relationship, and we have proposed to finance other equipment as well.
Okay, Vincenzo, thank you very much indeed. Look, we have to bring this first session of 20 minutes to a close because we're at 31 minutes, so we're not doing very well. It's down to me, so because what you're saying, guys, is really interesting. So thank you very much for your contribution to that first session. Let me just come back to the audience. We've got a bit of problem with Edward's mic. So Edward has passed on the result of the first poll to me. So it seems as if technology does make it easier. 76% of our audience say that digital makes it easier for the vendor to consider finance as just a payment option. So it seems the conclusion is the audience believes that it doesn't matter if it's a funder or a broker who enables the transaction. I'm going to caveat on that this point about transaction size, which Vincenzo was making, I think, and which Malcolm and Joe both talked to. If your transaction size, I think, Malcolm, you were saying your sweet spot was £1,000 to £25,000, then
particularly in soft asset space.
Right, exactly. And I think as well that talks to things that Jason was talking about in the sense of if your transaction is at that size, it needs to be massively automated. It needs to be auto-decisioned and e-docked, and you'd need no human touch on that. But both for the sort of service that you're giving to the customer, and also the amount, the absolute pounds of income you can make on a £25,000 transaction is finite, regardless, however the margin is, and therefore the system has got to be highly automated. Guys, thank you very much for that. Let's move to the second section, and I'm going to pose the second poll question. Edward will do the technology and put the question up. But the question is, provocatively, brokers add cost to finance that will only be paid by end customers who need help finding finance. Technology doesn't change the pecking order. Primary funder first, broker when needed. And again, your options are on the screen. Strongly agree, neither disagree nor agree, strongly disagree. So if you can work your way, the audience, work your way through those. I'm not sure that yet we've had any questions from the audience, so we're really keen. Yep, well, okay, we've just had one question posted, which I just need to scroll up a little bit here. Okay, wow, it's a long question. Here we go. The question is, we are on our second system in 10 years trading. We tried to adapt and change our first one, which was painful, so we invested in a new one. It has taken us 12 months to achieve. It's been challenging. However, it was the best decision. There we are. This is for your benefit, Jason. We have integrated NETSOL's Flex calculator, which has been worthwhile. However, my biggest challenge by far is not the technology, but our requirement for a universal document that can be accepted by all lenders. If lenders want more business from brokers, I believe they should be making it easier for us to acquire a unique document that is accepted by a majority. Okay, before we get into the next section, I'm guessing I know what Joe and Malcolm will say to this because they place business as well. And Vincenzo, I'd be interested to see your answer. Joe, your views on this idea of a document that all lenders will accept?
Yeah, it'd be fantastic if that could happen. It really would. Unfortunately, the reality is that the broking market will, deal with a variety of different lenders, some big, some small, and some of the tier 2, tier 3 smaller lenders, they simply will always have their own documentation. Some of the funders that we're dealing with, still insist on wet signs and original wet signs to come back before they'll process. The ideal thing is to get the majority of your business in this process. Shire have universal agreements. We have universal agreements. Our documents are accepted by 60% of the funders that we use. So, I think this kind of white label situation was more prevalent back in the 90s. Customers I believe are more aware now that there is a funder in the background, so the white label thing isn't as important as perhaps it once was. And we a lot of the deals that we do, it's a blended document. It may be our document, it could be somebody else's, the funder's guarantee, the funder's prepayment letter, or whatever else it needs.
Joe, thank you. Malcolm?
Yeah, I agree with Joe completely. It depends on your funders, and I think you can also look at hard asset and soft asset funders. In the hard asset space, often they won't take the universal sort of documents, and I understand it because they're larger deals, they're more complex, there's more return conditions, etc. But in the soft asset space, you're working on the sort of 80-20 rule, a bit like Joe was saying about 60%. We're probably at the sort of 70-80% where it's accepted on our universal doc. The hidden benefit to that for us as a hybrid funder is we can make an informed decision. Do we fund it ourselves on our own book, or this month are we going to 80%? So can we then place that with a funder? And we're very proud of our hybrid nature, and all our panel of suppliers and vendors know that we have funders in the background. And that's our unique offering, because we can say not only yes or no, we can actually also say, well, we do have a specialist funder that can help you in these scenarios.
Vincenzo, I guess I know your answer. You're going to say a unique lender document is okay as long as it's the SCEF document.
Exactly. Yeah, but there would be, I think there is, if we could have one set of documentation which is approved by all the lenders, and the FLA could do that, a universal document. I think it exists as well. That's, any lender could could then get assigned or use as a universal document, then I think that the differentiator between a broker and another broker is going to be the level of service that they provide, which is in essence this. I want to go back to what Malcolm said again on sides matters. I don't want to be controversial here, but it is true that technology is absolutely important when you fish in that pond. When you are originating and funding deals below 150,000 or 200,000 pounds, you need a system that will allow you to credit score and do the documentation, which we do. We serve some of the market very, very well, like the agricultural market, for instance, where our auto decisioning is very high. But the challenge is when you're negotiating a very large transaction. Most of the time, those documentation will be ripped apart by the customer, because they have a squad of legal people that want to lower the indemnity, do this, do the other, and as well, and that's why I think that it's important to have a very good collaboration between the lenders and the brokers, especially on the large transaction. Malcolm, a transaction of £5 million, for instance, putting that on a book of 200 million is going to be a big concentration risk, isn't it?
Yes, exactly, and that's really now a hot spot. So it's you're correct. There's different parties for different things, isn't there? And that's where the banks and the larger players come into their own.
Correct.
Sorry, Vincenzo, I don't mean to cut you off, but can we get to the second section? It's brilliant, actually. It means how smooth and natural the conversation is that we just keep going. But we have to try and bring.
And can I just chime in one thing, just briefly?
Yeah.
From a lender background, when you're looking at universal documents or assigned documents, part of the issue is from a risk perspective: are my T's and C's covered? Am I protected? But part of it is an operational burden of processing documents that are from another source, and often there is more burden on banks and lenders' operating teams to process that sort of thing. So there can be a reluctance, but that's based on old tech and old thinking. These days, lenders with the right tech, they can configure multiple templates for different audiences of different channels and for different shaped deals. So I could say, right, this has come in from Malcolm. It's one of these. It should be on that document, and that can all flow through systems and auto processed if they want it to. So it is possible to have multiple documents running now without an operational burden for lenders.
Jason, thank you very much. I agree. Okay, moving on. So the next section is asking us to debate the opportunities and challenges associated with replacing a primary lender with a broker alternative. So this is an account, a dealer, a manufacturer that's been working with a bank-owned leasing company, an independent leasing company that's holding the paper and switching. I actually wonder, having talked to all of you in prep, that whether this actually happens. It's not so black and white as someone just moves from one place to another. But that's the topic that we're looking at discussing now. If I can come to Joe first with this, and sort of the direct question would be, how often do you feel as if you take a dealer away from a relationship with a bank and bring it to your own organization, or how often isn't it much more relevant that you're finding a dealer or a reseller for the first time and helping them with finance for their customer base?
Well, both really. As I said before, me and the sales team, we spend our lives trying to forge new relationships and develop our existing relationships. Taking a supplier from somebody that's dealt with them for a long time takes a long time to do, and you're not always successful in doing that. If you look at the established brokers out there, the Shires, the Kennets, and other people like that, they've dealt with people for a long time. So we've had relationships with people for a long time. So it is difficult to break down those barriers, and often you get into a situation where you get an opportunity. You might be a better broker on that day than somebody else. You'll get a deal turned around that somebody else can't, and that that's your in. So that's what we spend our time doing.
Right. Okay. And Malcolm, the same thoughts to yourself. How often do you feel you take a source of business away from a primary lender?
I think taking it away is very hard, but what I'd say, if I angled the question slightly differently, I would say the people we try and get on board in our suppliers are normally 90% of the time just not being served by the banks.
Right.
So they may be a smaller local supplier, they may be newer, they may have a smaller net worth, they might not have as much interest, they might not be writing 5 million of new business per year. So they're not really getting served. So they feel a very small fish in a very big pond. Whereas when they come to us, we try and treat them with they have their own account managers, etc., and we work with them and take them on the journey. And often what happens is they grow with us, and as they get bigger, they come on board. There are the odd big manufacturing relationships that you have, but that's more larger relationships. That's less often than the others. We tend to write our business in a very spread across. There's no one supplier that dominates everything that comes into our business now. It's very well spread. So that's how we get it. So,
and that spread eliminates risk from your business, doesn't it? Because
it does, yeah. It's where it's extremely difficult is if you've got a large supplier or manufacturer, particularly on the hard asset side, where there's residual value risks or there's a real support network there, or a manufacturer subsidy or something like that. You just can't compete in those sections, from my experience. But
right. Vincenzo, if I can bring this back to you, because I think you have let's say you've got the vendor relationship. I suppose the first question is, do you frequently lose a manufacturer or a reseller or a dealer to the new broker, the new tech-savvy brokers?
No, I've never experienced that. When we lose a relationship in general is because that manufacturer has been acquired by a competitor, and therefore, if that competitor has already another solution or a captive company, then that relationship will die. One example in the technology sector, John, you will remember that, is EMC. You remember it was a fantastic program for a lot of different funders in Europe and globally, and all of a sudden was bought by Dell and therefore served by Dell Financial Services. So the party was over for a lot of vendors. I haven't experienced in my 20 odd years of 25 odd years of experience anything like that. But I actually seen the collaboration between brokers and lenders growing in that sector. SG Equipment Finance, for instance, on the technology side, for instance, we have two relationships with two very tech-savvy brokers that are providing a part of the service to a large distributor we work with. We provided the documentation. We take care of, obviously, the credits, the lending, all the KYC, all the kind of boring stuff, let's say. And the broker does the education, the salesmanship with the broker, so with the distributor. So there is more and more a collaboration to be set up there for brokers and lenders.
Right. Okay. One thing to come back to all three of you. One thing that you've talked about is this size of transactions and where the sweet spot is for your businesses. And more, I sense that Scef is looking for the sort of OEM type vendor partner, possibly on a sort of global basis beyond the UK as well. And Joe and Malcolm, you're looking more for the intermediary, the agent, the reseller, and your sweet spot of transactions is this 1 to 25,000. In that reseller space or dealership space, and you're sourcing your business through the dealers who may be dealers for an OEM, are you finding that a product like dealer finance or stocking finance is something that the banks can provide, but can you as brokers provide or place stocking finance for your agents and your dealers? I guess, Malcolm, can I come to you with that first?
Yeah, we don't do a lot of stocking in our area. We tend to we've got different routes for people, from loans through to invoice finance. But stocking finance, we don't get a lot of queries. We generally use our broking panel for that. There's a few brokers there's a few funds in the market that like stocking, so we generally introduce those leads to them. But probably only a few a month will come our way in that particular area. So
Okay.
probably Joe and Vincenzo are better placed on this particular question.
We'll get the odd inquiry now and again, and we'll tend to pass that on. You know, as Malcolm said, people are sometimes better served with loans and other options when they're looking for that type of facility.
Okay, thank you. Jason, to come to you, there's one thing that I wanted to. I know you were keen to come in on a couple of the other points that the guys have been making, but one thing I'd like you to address as well, if possible, is if the systems of the lender and the OEM vendor are linked, and the sort of CRM system of the vendor is linked into the finance company's processing system, lease administration system, that's quite difficult to break, isn't it? I would assume. I mean, there's a portfolio of transactions that are already running on that systems that are linked. Doesn't that make it very difficult for a vendor program to move from a principal to an intermediary?
In short, there is a stickiness for sure, particularly as the finance element for a vendor is not primary, it's secondary focus for them. So it's sort of like it's a means to an end rather than a primary source of their business. So they don't want the distraction. However, if you think about they've had a slick experience with SG for a long time, and the brokers have been picking up the declines, let's say. And then let's make up some numbers around that. You know, the SG has been funding 85% and brokers have been picking up 15%. I mean, that's a made up scenario. Yeah. In a challenged economic environment, it's probably quite different metrics at this point. And let's make it up. Let's say it's now 50-50 or 60-40. Then you've got a happy path, lots of tech here, and then a harder, more complex path on the broker space, which you need to satisfy more challenged credits in a more challenged economic environment. So in that scenario, it's not that they're having to face with complexity and challenge in the operational process anyway, the dealer is. So for a broker to come in to say, well, you know what, I can provide you the same or potentially better service experience, just as easy with all the tech you need just to pass it to us, 100% of your business via one interface, then that might be enough to unstick those relationships and move towards a broker. I'm not surprised Vincenzo hasn't seen this happen yet, because I think it's very much a current and very emerging trend, because brokers now have tech and they themselves, and they're now able to deploy tech or consider deploying tech into dealer channels to do that. And we see in that kind of ease point of saying, okay, what about the super easy stuff that nobody should be touching? You know, we've deployed tech into brokers where they've got very strong dealer relationships and very strong lender relationships on the back end, and they configure in the system for that shape deal, from that dealer. I always want that to zip straight through my systems. I'm not going to touch it, straight out to my lender and get an auto decision, zero touch, and that's a broker channel.
Right.
You know, so this is very possible now. So that service experience, it comes down to, you know, when you want someone to unstick from whatever they've been used to, you've got to provide a value proposition. Yeah. I think brokers are now kind of well positioned to do that.
Okay, interesting. Okay, we've completely messed up the timing of all this, but let's come back to the answers to question number 2, which was about whether brokers added costs to financing that ultimately is paid by the customer. A fascinating answer, actually, because it's completely split. There is no one saying it's all yes or it's all no. We've got, just to do the middle 3, we've got 27% of the audience saying they agree that it does add cost. We've got 19% who've got no opinion, they neither disagree nor agree, and we've got 37% saying they disagree with that statement, and therefore presumably they think that there isn't additional cost. So that's
maybe the 37% that say disagree are doing the job for free.
Maybe, but I doubt it. Okay, just a couple of questions that have come in that are quite interesting before we get on to a very short third section. And this is one I guess more for Jason, Joe, and Malcolm. What are the latest innovations in broker tech that are coming next? Is there something that everyone's working on? Joe, can I start with you on that, as you're in the middle of it, starting a new?
Well, for us, our thing is our new system, and trying to get from proposal to payouts in theory an hour. If we can do that, fantastic. So that's us. And then going on from that, if we can interact more with the funders and with their APIs, perhaps auto decisioning as well. Again, that's going to make the whole process a lot simpler.
Okay, Malcolm.
Yeah, our one's really building on our auto credit decisioning and really and being very focused on sectors rather than being generic, and also trying to work on a journey where you completely automate everything 100%, right down. So you have a particular, say, basket arrangement on an online platform that sees the accept, decline, documentation, payout, all that sort of flowing through. So we're working hard on solutions along those. Often it's driven by relationships. So you have a relationship and then you build a solution, and sometimes you sort of build it the other way around and hope they will come. So but we have got a development team that's always working on new propositions.
Okay, great stuff, Malcolm. Jason, I guess you should be the expert at answering this question as well. What are you about to bring to the market?
I think what we're seeing at the moment is sort of, if you want to call it, sort of super configurability. So, you don't have to create one slick journey. You can have 5 journeys running simultaneously for different environments or more, so you can qualify for this shape deal for that kind of customer. I want it to zip through, not touch the sides, and I want it to go there. I want to get an auto decision, come back, and everything zips through and it's nice and low touch, because that's a kind of low risk or low value deal. For other types of deals, for complex assets, complex deal sizes, complex credits, slow it down. Let's think about it. Let's deploy the expertise where it matters, and variations on. So I think where we're seeing an awful lot of uptake at the moment is the ability to have lots of configurations of lots of journeys running side by side, but keeping the efficiency where it matters. So you can have the expertise, deploy it where it needs to be, but for the non-value add data flowing, that can all just zip through, no problem at all. And that's all kind of tech that used to be a project for each journey. Now it's not. Now it's sort of configuration in a few days.
One thing that's come to us from the audience, which is quite interesting and talks to the technology point, is there are platforms now that run the credit acceptance and match a customer's credit status with the different funder lending scorecards. So is there technology now that is enabling an intermediary to put the customer's credit profile into a system, and then it will say, oh, place this deal with lender X or place this deal with lender Y? Is that technology that you use, Malcolm and Joe?
We don't use that at this stage in terms of receiving our deals, but we certainly use it in-house in making decisions on where deals should be accepted, on what tier of credit it should be, right from new start to established, or established that's had a few bumps in the road. So we use that, and then we also know our what we've not got is a link into our funding panel to then auto decision with them. But we do use our links with our funding panel, and there's some very good auto decisions out there.
Okay, Joe.
Yeah, same thing. Exactly the same thing.
Okay, and Jason, are you seeing that? Are you seeing these platforms that place the deal for the intermediary to the right end user?
That's to me, John, was it?
Yeah, sorry, excuse me. Yes.
Yeah, sorry. Yeah, I no. I don't think there is so much need, except for a couple of use cases, frankly, because I think the kind of auto matching deal to a lender is the role of the broker. That's the service that they're providing. They're understanding the customer needs, adding value, providing expertise and reassurance, and saying, right, I think the best place for you is this lender, not this one, for these reasons. And that's the service they're providing, and what they're earning their fees for. Yeah. I think to try to automate that is disintermediation, frankly. Right. I'm not sure that's required. you want efficiency and connecting to lenders via API. So all the data transfer and the sort of non-value add of pushing one thing to the next place, that needs to be automated, but not the decision of where to place it. That's the broker's job.
Okay. Okay. Look, we're going to go incredibly quickly to our last question because there's still over 100 people online, and we want to give them their chance to look at the last question. So the last question: the longer the distribution chain, the less control the vendor has over the customer experience. Traditional vendor relationships enable control. Broker intermediaries reduce that control. That's the question for people to, and I can see the answers are whizzing in pretty quickly, so I'm going to take that off because it will distract me. I think behind this question is this concept of brand as well. I think particularly for the big global brands, they want their finance solution to come with the same pedigree, if you like, as that brand carries. If the transaction is going through an intermediary, does the brand get diluted because they don't know who the end user funder is going to be? It could be a tier 1, it could be a tier 2, it could be tier 3. So if I can sort of condense, because we're so over time, and I'm hoping you guys can stay for an extra 5 minutes after 2 o'clock. Can we just ask all three of you to give your opinion on how important brand is to the source of business that's bringing you the transactions? Maybe just to be fair, Joe, can I start with you, as we haven't started with you on too many topics?
How important is the brand? Yes, it is important, and we've got, I suppose, two customers. You've got the introducer, the vendor, the manufacturer, whoever it might be, and then we have the end user. Now, to my mind, as long as the end user is being treated professionally and the transaction is done in a timely fashion, there are no issues. It's transparent. They know what they're paying, when they're paying, and whatever other fees there might be, documentation fees, annual service charges, and all of that kind of thing. Then that's the job of the broker to protect the end user and ultimately the introducer. We deal with a number of different banks and finance companies. Everybody's regulated to the nth degree now. And if we didn't look after those end user customers and transact the deals in a timely fashion, professional fashion, then we'd lose the business anyway.
Right. Mm-hmm. Yeah, get it. Malcolm, to you.
It depends on as a broker, you have to be very flexible with your vendors. Some it's very important to, some it's less important to, and we will flex accordingly with white labeling, etc., joint marketing, etc., on these particular areas. Some are getting very interested, particularly on some large tenders on the green space. I know that's pushing it and the green and sustainability credentials of the business. So we're very conscious of that now as part of that, because they're very interested in who they're partnering with, and everyone's doing the right thing. So it's about being bespoken it to the right market.
Right. Vincenzo.
John, in my opinion as well, is the brand is very important for the manufacturer and the customer, but then it depends in which part you are. For a small manufacturer or a small customer, there are customer underserved, as Malcolm said. Whatever brand you're going to have is going to bite your end, isn't it? He's happy that you funded whatever investment he made. Mm. We had situations where, notwithstanding being behind undisclosed for a vendor, we had customers wanting to know who that lender is going to be behind the scene, and for reasons that are related to the pool of banking. Some customers don't want to open up to any other bank that is not already vetted in their pool of banking, or as Malcolm said, the sustainability credential, ESG credential nowadays that are very, very important for large corporate. So brand is important, but once again, it depends on the pecking order where you are.
Thank you, Vincenzo. I tend to agree with you. Just to give you the answer to question 3, and I'm conscious of time. Interesting answers. I think we have 55% agree that bringing an intermediary reduces control, and 33% disagree. I think this whilst it brings massive value in terms of expanding credit bandwidth and technology and speed of decisioning, there are consequences, obviously, of bringing an intermediary into the transaction. It's been an absolutely fantastic and fascinating conversation, everybody. Thank you very much indeed. Jason, you, outside of your role at NETSOL at the moment, you used to be a practitioner. Just interested in your views on that concept of the brand of the manufacturer and whether the customer would like to know who's funding his transaction.
I think, and I've also been an SME with asset finance, and so SME owner with asset finance contracts. So I've been all the way through the value chain, that as a lender and now into tech. And I would say, similarly, when you go on to buy your insurance, we often take car insurance from providers that we don't know, but there's a reassurance there based on making sure they're a regulated institution. If you look at a lot of the challenger banks, of which some of them I were in, their brand presence on the pavement is next to nothing. In the financial services industry, we all know them and respect them very well, but out there in the real world, they don't know. So I don't know how much value that brand really has. They might do a quick Google search, make sure they're regulated, fine, move on, I'll accept it. So if you believe that, then it's more about, I think it's much more about service proposition, and can I get that? And obviously the commercial terms that are coming with that lending relationship rather than brand. I think the brands that a lot of lenders have in this space are within the financial services industry, not direct to customer. So I think it plays less of a role.
Thank you, Jason. Thank you. Well, now we come to all the thank yous, because I think we've reached the end of our time now. Thank you very much for the 78 people that are still online, even though we're 5 minutes over time. First of all, Vincenzo, Malcolm, Joe, thank you so much for joining us this afternoon.
Pleasure.
The conversation has been absolutely fantastic. I think the conversation could have gone on for another couple of hours, actually, and we haven't got through half of the stuff that we prepped.
Only if we're in the pub.
Well, I was going to say, we have to release you now so you can go meet your colleagues in the pub that have all been listening on the screen in the pub. Jason, thank you very much for joining the panel, and thank you, NETSOL, for sponsoring the event. But the most important thank you is to all the people that have dialed in and given up their lunchtimes to listen to this. It is recorded, so it is available to play back if people want to look at it again. Edward, have I forgotten any thank yous?
No, I don't think so. Thank you all very much indeed for the event. A good session, I think.
Okay, thank you very much indeed to everybody. Have a great weekend. Have a fun afternoon, and let's hope the rain stops.
Thank you, everyone. Thanks a lot.
Take care.
Thank you.
Cheers. Bye-bye.
Bye-bye.
Bye.
Bye-bye.